There are three types of time frames we consider in trading, each serving a specific purpose: analysis time frame, higher time frame, and entry time frame. In this video, we're going to talk about multi-time frame trading and how to combine these charts to make well-informed trading decisions. If that's something you're interested in, make sure to hit the like button to show your support and subscribe to our channel if you're new. See you after the intro and disclaimer. As I mentioned, we have three time frames: higher time frame, analysis time frame, and entry time frame. Depending on their trading style, traders use a combination of time frames that fit into these categories. For example, scalpers may use 15, 5, and 1-minute charts to enter a trade. On the other hand, day traders and session traders may utilize higher time frames to analyze market movements and make trades. Each of these time frames has different applications, which we will discuss. Our analysis begins with the analysis time frame. Identifying the market direction is the first step in analyzing the chart. We should determine who is in control: buyers or sellers. Are we in an uptrend, a downtrend, or witnessing a directionless market? After defining the market direction, the next step is to zoom out to a higher time frame to evaluate how long the trend might continue and identify possible reversal points for the short-term trend. Combining these two time frames provides a comprehensive view of the charts. In the final step, we zoom into the entry time frame to find confirmations and execute the trade. To summarize, first we identify the market direction in the analysis time frame. Next, we determine how much room we have before reaching potential turning points. Finally, we execute trades in the lower time frame. As we begin our analysis on the chart, the initial step is to outline the market structure's schematic to understand the market direction. The primary objective of sketching a schematic is to observe the recent movements in the line chart to get a clearer understanding of who is in control and pinpoint the key structural levels. Imagine these are the latest market movements on the 1-hour chart, which is our analysis time frame. Every reaction to a certain price level is considered a level of market structure. However, the strength of a price movement is determined by the imbalance. So, if we find a fair value gap in the latest impulsive move, this area could be a potential supply zone to go short along with the dominant downtrend. These are all the concepts we need in the analysis time frame. So far, we have identified the market direction, key levels, imbalance, and a potential opportunity to go short. But imagine if our higher time frame structure looks like this. So basically, the higher time frame suggests an overall uptrend, and right now, the price has rejected a key demand area. This area can be a turning point for the short-term downtrend, and the price can continue upward along with the higher time frame direction. With all that being said, we cannot place sell orders on this 1-hour supply zone because the higher time frame key levels are extremely important. This demand area can push the price higher, and when we reach the supply zone, there will be a contest between buyers and sellers. If the buyers overcome the sellers and break this area to the upside, we can confidently say that the short-term downtrend is over and the price can push higher. Therefore, our analysis can continue forward in our analysis time frame now that the higher time frame and the lower time frame are aligned. Now here comes a question. In the same scenario, under what conditions can we place sell orders on this supply zone? We can only set sell orders if our higher time frame bias is bearish. If we get a break and close below this area in the higher time frame, it indicates that the buyers are no longer in control and we have a market structure shift. Therefore, this supply area can become a potential trading opportunity to go short. We can set a sell limit at this zone and expect the price to reject it to the downside. For a more conservative and safer entry, we can wait for a confirmation in the entry time frame, which must be a time frame lower than the analysis chart. Finding a confirmation in the entry time frame can give us a more optimal entry and a better risk-to-reward ratio. However, It can also provide false signals before the expected moves happen in the market, because the market can be very unpredictable. This supply zone is a great opportunity to go short along with the dominant downtrend. However, being rejected exactly from this box is not guaranteed. The market can find multiple supply areas inside this range. Each of these supply zones represents a potential trading opportunity based on our trading plan. If you cannot technically identify which zone has a higher chance of rejecting the price, and all of them fit your trading strategy, a great technique to seize this trading opportunity is to place multiple orders, each with reduced risk. Most of the time, there is no particular reason why the market rejects the first or second zone, or it might neglect both and push higher. Trading is a game of possibilities. While we cannot change the outcome of a single trade, we can control the outcome of multiple trades with a good risk management plan. That is why a risk management plan is so important. It directly affects the overall outcome of trading. The entry setups you can use in the lower timeframes can include various price action signals, from a single engulfing candlestick pattern to an advanced smart money liquidity sweep pattern. Any of these can be an entry reason. The important point here is to always backtest your trading setups before trading them in the live market with your hard-earned money. So let's have a quick recap and then see some real chart examples. The chart analysis begins with the analysis time frame. In this time frame, we generally apply most of the smart money concepts on the chart. The first step is to find the market direction and draw a line chart based on the most visible swings. Usually, most winning trades occur when we can clearly identify the direction. Then we pay attention to fair value gaps, supply and demand areas, and liquidity zones. With all these concepts applied on the chart, we should have a directional bias and optimal trading zone. If not, then we can simply close the chart and look for another trading asset. Here is the checklist required for the analysis time frame. Now, it's time to zoom out to a higher time frame to see if the lower time frame analysis aligns with the bigger picture. There are two major concepts we look for in this trading chart. First, we want to identify a directional bias for the price in this time frame. Second, we want to identify key higher time frame support and resistance levels. Higher time frame key levels are extremely important because even a small reaction to them can signal a major trend change in the lower time frame. Here is the checklist required for the higher time frame. The next step is to zoom into the entry time frame and look for confirmations if needed. Now that we have a clearer view, we wait for the price to enter our trading zone and place our trade. Trades can be made in both the analysis and entry time frames, but a safer way is to zoom into a time frame that's twice as short and find a reason to enter. This could be a change in direction showing a possible turnaround, letting us predict what might happen next. Another way is to look for patterns like double bottoms and tops for a perfect entry in this lower time frame. Now, let's look at the Euro-Dollar 15-minute chart. Recent price moves show the market is going up, but the price hit a resistance area it can't get through. At the bottom, there's a support area that's been stopping the price many times recently. So, it seems like the price is stuck in this range. Our directional bias is bullish, so we're only looking to buy this pair. As a price action trader, there are two trading scenarios here. First, we wait for the price to return to the support area, place a buy position, and set our target at the resistance. Alternatively, we can wait for the price to break above the resistance, then look for a pullback to the previous resistance, which has now become support, and enter a long position again. Now, let's consider the smart money perspective. We've identified two liquidity areas. When the price reaches the support area, traders open long positions and place their stops just below this level, creating liquidity. The same happens at the resistance zone, where traders go short and place their stops just above the level. So, we have both buy-side and sell-side liquidity zones. Since our bias is bullish, an ideal trading opportunity would be to wait for the price to clear out the sell-side liquidity, and then find a demand area to enter long positions. Our target would be the buy-side liquidity. This rejection with a long wick could be an optimal demand area for future bullish momentum. If we zoom into lower timeframes, we'll likely find fair value gaps within this zone. But for now, these are all the concepts we've used in the analysis timeframe. The next step is to zoom out to a higher timeframe to see how our analysis fits into the bigger picture. Our analysis timeframe was 15 minutes, so let's switch to the 1-hour chart. On this chart, we can see that the price was in a long-term downtrend until it reached this level. After several attempts, the price failed to break below and started forming higher highs and higher lows. This indicates a bullish bias on the higher time frame. Both the 1-hour and 15-minute charts show a bullish trend. If we enter a long trade, our target on the higher time frame would be this turning point. Now let's return to the 15-minute chart. Right now, we just need to wait for the price to drop below the support area to gather liquidity and find a demand zone to buy this pair. Let's zoom into a lower time frame to observe more price action, which is our entry time frame. On the 5-minute chart, we can see several small fair value gaps on the left side, which represent our demand zone. When the price reaches these levels, we expect it to bounce back up. One aggressive way to enter the trade is to place a buy order at this zone and set our stop loss just below this range. For a more cautious approach, we should wait for a signal that shows buyers have taken control. Currently, there's strong selling pressure. The recent move has created a bearish imbalance, indicating that sellers are dominating. If the price pulls back to this area, this order block could act as a significant supply level, and we expect a rejection downward. Breaking above this level would show that sellers are no longer dominating, and a reversal might happen. Now our bias changes to bullish on the 5-minute chart, and we can confidently go long. Notice how we've returned to the range, indicating this move was likely a fake-out or a liquidity sweep below these equal lows. We can now enter a long position and place our stop below the fair value gaps. This example demonstrates how combining these charts can lead to well-informed trading decisions when conditions are favorable. Remember, improving trade quality also involves knowing when not to trade, which is as crucial as knowing when to trade. If you're interested in learning more about our trade entry strategies, subscribe to our channel. If you found this video helpful, please give it a thumbs up to support us in creating more content. Feel free to comment below with your thoughts and suggest topics you'd like us to cover. Thanks for watching, and I'll see you in the next episode.